Hi, this is the first in a series of DCF valuation videos I plan to create and publish on Seeking Alpha. Now today I want to talk about Gilead Sciences. Full disclosure, I am long Gilead Sciences because I think Gilead is the best value right now in the large cap biotech space. Now I did this valuation a few weeks ago when shares were trading in the $63, $64 range. Since then, shares have had a pretty good run. The shares closed this week at about $73 and change. And Gilead is set to report earnings this upcoming Wednesday, July 26th. So I wanted to get this video out there before then, show you kind of the assumptions that went into my valuation and the overall results. And I won't make you wait for the results. I'll tell you right now that I think Gilead shares are worth, as you can see down here at the bottom of my DCF, I think they're conservatively worth about $86 per share. So let's just quickly go through my DCF valuation so you can see the assumptions that I'm making. So for revenues up here, this past year, they had about $29 billion in revenues. I'm assuming that revenues are going to decline about an average of 10% a year over the next 5 years. So I'm not assuming any sort of growth. I'm actually assuming declines for the next 5 years. And then years 6 through 10, I'm assuming further declines of about 1.38% a year. And then finally, when we get to year 10, after year 10, that's when I think that we'll finally get back to growth in revenues of about 2.37%, which at the time was the rate of the 10-year Treasury. So I'm not assuming any robust growth, just kind of the natural growth of the economy. Operating margins, I have them going from, and now these are adjusted operating margins because whenever you're doing a DCF valuation of a tech company or a biotech pharmaceutical company, these companies that have substantial R&D expenses, you should capitalize those expenses. And there's a process to do that. And once you capitalize those R&D expenses for Gilead, it results in a bump up in operating earnings. But that's going to get all taken care of when you calculate the cash flows. But it does help you, when you capitalize R&D expenses, it does give you a better view of profitability measures, such as return on investment, which then feeds into your assumptions for growth. Because if you know kind of how much will be reinvested by the company and the return on that investment, you can come up with a better assumption for earnings growth going forward. So it is necessary to capitalize R&D expense. So I have margins, as you see, declining quite a bit, and this is because, and the revenue decline is also a result of the Hep C drug portfolio. I think all of us are assuming that is going to decline quite substantially over the next few years. Hence the decline in revenues, and I have operating margins declining because you have kind of a reverse operating leverage thing going on there with the substantial decline in revenues, where fixed costs, stay the same, yet revenues are declining quite rapidly. So I have, after year 10, 58%. This is adjusted operating margins. So you can see that operating margins I have declining about 12% over that 10-year period. And of course, every company needs to reinvest to grow. In Gilead's case, I'm not assuming growth. So my reinvestment rate is, a bit lower the first, 10 years, and then after year 10, I have that bumping up. But the reinvestment rate is the portion of the after-tax operating earnings that are being put back into the business. For a company like Gilead, this would be in the form of R&D primarily. And so I'm assuming, as you can see over here, my net reinvestment column, if you can see that, I have net reinvestment of about 700 plus million this first year, and then, you know, by the terminal year, about $1 billion in net reinvestment. And when I say net reinvestment, that's above and beyond amortization and depreciation. So for example, this last year, this last year after capitalizing R&D, I have amortization about 1.4 billion. So assuming in that terminal year you have about the same level of amortization, I'm assuming they're putting about that 1 billion plus another 1.4 billion, it's about 2.4 billion back into the business. So I am assuming pretty robust reinvestment back into the business. And I'm assuming a return on capital going back up here. I'm assuming return on capital declining quite substantially over this 10-year period, going from 58% in the base year all the way after year 10 down to 15%, which I kind of assume to be the industry rate of return for, you know, the biotech industry. You know, established, stable, large cap biotechs returning about 15% a year on the capital. And then my cost of capital, I've assumed for the first bit an 8% cost of capital, but then declining to about 7.5%, which I don't think that's too low of a cost of capital. I think given the interest rate environment and with interest rates where they are, 7.5% could actually be argued to be a little bit high, especially given given Gilead's not in a, you know, cyclical business. It's a fairly stable business compared to a lot of cyclical businesses. It's in the healthcare industry, and people are going to need to pay for these drugs whether or not we're in a recession. So that's my assumption for the cost of capital. So looking down here, you can see, you know, revenues, operating margin, EBIT, after-tax EBIT, net reinvestment, ultimately results in my free cash flow numbers over here on the right-hand side. So year one, you know, this next year, I'm assuming about 11 billion in free cash flow. That declines every single year down to the year 10 or the terminal year. I'm assuming, you know, in the terminal year, about 5.5 billion in free cash flow, and that would, you know, continue on about that level. So I'm not assuming, you know, anywhere near the free cash flow levels that we have seen in, you know, 2014, 2015, 2016, that have just been great, you know, really nice free cash flow because of the Hep C portfolio. I am assuming that, you know, in the terminal year, this is going down to 5.5 billion. When you put it all together and the terminal value off of that terminal free cash flow is 107 billion. Present value of the terminal value is about 50 billion. Present value of those cash flows over the next 10 years is about 55 billion. So value of the company evenly split among the terminal value and the value of the cash flows over the next 10 years. So total value of the operating assets of the company, or total value of the enterprise value of the company, at $106 billion. And then Gilead's got debt of 26 billion, cash of 34 billion. So the net of that, you know, you're talking a little less than 8 billion. Add that to the 106 billion, you get 113 billion, 113.7 billion for the value of the equity, divided by 1.32 billion shares. That's how I get $86.17 a share for my value of this stock. So I think it's a great value. I think there's still upside from here where we're at 73 and change. If the shares do dip after the earnings report, which they have tended to do lately, I would be a buyer. I'd be a big buyer anywhere under $70 a share. Now, this is my opinion. This is based on my story for the company, my assumptions. If you have different assumptions or a different story for the company, I'd love to hear it. Love it if you could comment on this article, and I'll try and get back to you as soon as I can. Thanks for watching.